Hello, my name is Christopher Charlton from Centre Asset Management. It's Tuesday the 23rd of March. This week I've been asked by an Australian company to talk a little bit about the relationship between the British pound and the Australian dollar, what our views are and potential hedging possibilities. So before we start, I just want to talk briefly about the tallest building in the world, the Burj Khalifa in Dubai, which was inaugurated on the 4th of January this year. It actually closed down a couple of weeks ago, citing electrical problems. Not really the issue whether it opens up again or not. For me, it's more that this building represents the ultimate in overindulgence that was caused by the credit bubble that lasted nearly 30 years. I think in the years to come, we'll look back and see that this was the actual peak of that bubble or cycle. Apart from that, it also represents overcapacity, and that's a problem that's arising, I think, in China at the moment. With that, protectionism rising in the world and polarization, US political polarization, which could threaten global trade through maybe starting in the summer. These are all issues that will influence the Australian dollar. So that's why I wanted to mention them. And it is a basic assumption of ours that we will see growth contracting through the year, and that obviously will influence our forecast on the Australian dollar. So let's move on. If we're correct, at the moment the economy seems pretty robust. Right, interest rates are expected to rise again. So the Aussie dollar looks pretty well supported in the short term, and we could see a potential move higher into the summer, and then I think we'll turn down again as growth contracts. That's a fundamental assumption that we're making here. So if that's affecting the Australian dollar against the US dollar, how does that look then against the British pound? Actually, this is a 20-year chart. We're at pretty uncharted territory here, pretty much at a low of about 164. Where do we go from here? Strength in the Australian dollar is there. The weakness of the pound is clear, it's common knowledge. But how much of that weakness is already in the price? Probably the sterling will continue to weaken through the elections, but then we may have to take a rain check. So we could see a potential move like this, where we could see the sterling Aussie going down to maybe 150, maybe even lower to 140, and then rebounding in the second half of the year. So what does it look for an Australian company who wishes to hedge or wishes to invest in the UK throughout the year? This is his sort of cash, this is a chart of his cash flow. We have the exchange rate on the horizontal line and his costs in Australian dollars of buying 1 million sterling on the left, on the vertical. The exchange rate at the moment is right about 164, so his cost to buy £1 million will be 1,640,000 Australian dollars. Pretty clear. If the exchange rate moves higher, his costs will increase. If the exchange rate moves lower, his costs will decrease. Pretty simple stuff. So how do we look at our forecast for the sterling against the Australian dollar? Are we going to move lower first? We're going to go straight up, or maybe we're going to go sideways. So what are the opportunities to hedge here? We've chosen three strategies really to look at. This is our forecast, look down and then up, so let's have a look at the first strategy. Here again is the cash flow line. We'll just put the strategy one is just straightforward, buy the sterling outright, 1 year outright. The spot rate is at 164, forward rates are about 700 points at a premium, so the forward rate comes in at 171. What does that actually mean for as a forward rate is purely the calculated from the interest rate differentials. If I were to buy the pounds now and put them on an account, I'd only earn 0.5% rather than if I waited and had 4.5% on deposit with the Australian dollars. So the forward points just reflect this. So the forward rate would be at 171. So if we did that today, we would have our cash flow line looking like that, which is straightforward. There is 171 is the rate, and it would cost us 1,710,000 Australian dollars. we do this, we lose an opportunity gain. We gain an opportunity in the sense that if we have rising rates, we have a fixed cost, so we're not going to cost any more. But on the other hand, if the rates go down, we could have bought them cheaper, so we have an opportunity loss. So, the second strategy is using an option. It's an option, a call option for 1 year outright. An option gives us the right but not the obligation to buy sterling at a given price. Here we're looking at the strike price again at 171. The premium for this is about 850 points. It's about just over 5%. It's very expensive, but it's where it is at the moment, so we're going to go through this scenario and have a look at it. With the strike price at 171 and 850 point premium, our break even is then higher at 850 points higher. So we have, through the option, we have a 171 where we have the right to buy Australian dollars, so we're fixed there, and our cost therefore is still 1,710,000 Australian dollars. But we have a premium cost. So actually our cash flow moves higher affected by that premium, and we can see what our cash flow looks there now. So, and there we go, and it should go to 1,795. It works. So we have a higher cost, but we still have an opportunity gain if the sterling Australian rate falls below 155.50. Here we could still have the opportunity to buy the sterling cheaper than at the present level. And if it were the rate to rise, we are fixed and we are protected at this level. But 850 points is pretty expensive. Do we have a way of reducing that cost? We can. This is the third strategy, where we buy the call option as we did with 850 point premium, but we sell a so-called put option with a strike at 150. This is the reverse. It is, let's say, for a UK company who's looking to hedge against a falling pound against the Australian dollar, they might be interested to buy a put at 150, and we can sell that. So for that, we are reducing our premium. We get premium in of 185 points. So we're looking now from a premium cost of 850, we're now going down to 665, and theoretically, yes, there we go, we should just come down a bit on our cash flow. But to do that, we have sold our souls, as one could say, by being forced to buy sterling against Australian dollars at 150. So we have no more opportunity gain below 150. But for this here, now we have a maximum cost of 1,776,500 and a minimum cost of 1,556,500. So for budget planning, we pretty much know where we are. So let's look at it in the real world on our forecast. If we were to do these strategies, this was our forecast, maybe down towards 150, maybe a bit lower, and then up. We use strategy 1, we're just hedging at 171, we're fixed. We can sleep well, it doesn't matter where the rate goes, we know what our costs are. Maybe we want a little bit more than that, so we look at scenario 2 where we stay hedged at 171, but we have that opportunity to buy cheaper. So we have a cost here of 5.1%, which is expensive, but we have a potential gain. If the rate falls below 155, we will then break even and we can buy cheaper through the course of the year, or make a decision where we want to do it. The third scenario, we reduce our cost from 5.1% to 4%, but we have here, I've been having the mouse probably there the whole time, at 150 is where we would be forced to buy. So we have a cost and the gain there. So that's really it. Which one you decide to do, I personally think that if you have a strong conviction, then you just buy the forward or buy the option and then look to buy, which gives you, it's expensive, but then gives the opportunity to buy cheaper. That's it. Thanks very much for watching and have a good week.